So in today's video, we're going to talk about how no closing cost or low closing costs can help you get the home of your dreams. So stay tuned for a step-by-step process with the pros and cons, and we'll help you get your home. You're watching this because you are out in a very competitive market. We're still in a seller's market, and buying a home is extremely financially and emotionally stressful. When we're going through the process, you got to save for two things, right? You got to save for down payment, you got to save for closing costs. So one way that we can help mitigate some of the closing costs is to go with a no closing cost or low closing cost mortgage. You got your down payment covered. You may even have part of the closing cost covered. What is this going to do to you, and how is it going to affect you? And what is a no closing cost mortgage or low closing cost mortgage? A definition of closing cost is basically when you're going through the process of the loan, you're going to have costs that are associated with buying a home, such as your lender fees, which is like the origination fee, maybe a processing fee, and then you're going to have your services that are typically needed, your appraisal, you're going to have a flood certification, you're going to have other minimal fees that are part of the closing cost. And then you have your settlement charges, which is the settlement agent or the title company or even an attorney, where they charge you for the closing, the owner's title insurance, the lender's title insurance, and other charges to ensure that you don't have any liens or title issues when you're buying the home. And then you're going to go to the next section of the loan estimate, which is going to have your transfer taxes and things that you have to pay the state and local government when you're buying a home. And then finally, you have your escrow account, which is going to cover the taxes and insurance and the days of prepaid interest, which are like the days that you're going to be owning the home before your first mortgage payment is due. So when you add all those numbers up, you're typically at, I would say, anywhere between 2 to 6% in total cost typically. And that's typically a really high number because most people are going to save their 3%, 5%, even 10%. And there's a real big misconception out there that you need 20% on a house in order to purchase without, with a conventional loan. However, that's totally not true. So with that being said, the 2 to 6% in closing cost, that's going to afford you a better rate, something that's more like a market rate. When we say a market rate, we're talking about something with no points at that time, okay? However, if and when you're looking to buy a house and you're short on funds, having something with no closing costs or low closing cost is good. And the way that it works is like this. When you take a lower interest rate, we're making less money on the back end. And what that means is when you're making your mortgage payment, we're not getting a higher interest rate of return when you're making those payments. So when you buy down the interest rate, we're charging you upfront points or no points in order to get you that lower interest rate. However, if you need your closing costs paid for, we can roll in the closing cost by giving you a higher interest rate. Using that higher interest rate, we're able to make more when you're making your mortgage payments, and in return, we're paying for part of your closing costs. So that's called a lender credit. Now, the way that we want to weigh this all out to see if it's going to be something that's good for you in your specific situation is we want to look at how much interest you're going to pay over the life of the loan, or how long you plan on keeping it. Someone that only have 1 or 2 year orders, or maybe they're only relocated into an area for training for a short period of time, you may not want to spend too much on closing costs because you're not going to recoup that cost. That initial investment versus the initial monthly savings is not going to weigh out unless you need it to qualify for the loan. You also want to make sure that when you're getting a non-traditional loan and you're doing this consideration, that the prepayment penalty is not going to be a provision that kind of discourages you from refinancing. So if that opportunity does come up again where the rates come down, then you may not be in a good enough position to be able to take advantage of the refinance because of a prepayment penalty, or you may have paid too much into the loan upfront that it's not worth your time and effort to refinance. The biggest pros and cons are when you're going through this and you're looking for different options, especially in today's rate sensitive and inflationary environment. You're going to have fewer options to choose investors or lenders that are going to give you a lender credit that's going to make up the difference. And this is where I always talk about the difference between wholesale and retail. You should definitely shop. You got to shop. You got to be on top of your game when you're looking at all this, just to see, hey, if I'm going through a retail lender, how much more am I paying? And do they have an option that's going to give me enough lender credit to help me secure the property? Because properties are far and few between now. It's a seller's market. Everyone that has their houses right now have lower rates. And with the lower rates, if they sell their house, they're going into a higher rate. So you really need to like entice them to be able to buy their home. Make sure you know all of your options. Make sure you are financially capable of handling the costs that are associated. Typically with first-time home buyers and maybe like, shorter term residences, you really at this point, the average home buyer or home owner is going to move or refinance within 7 years. So make sure you weigh all those options out to make sure that you're picking the right option for you. If you could afford a bigger down payment sometimes, that will lower the closing cost. Or instead of putting a bigger down payment, let's say, 10% down, we may want to put 5% down and use the remaining amount towards like closing cost. And then anything that's left over, you could apply towards your down payment. So in this type of scenario, I would possibly do like 7% down, maybe even like 7% down, 1% to, buy out your mortgage insurance with an upfront premium. The rest of the money maybe covers some of the closing costs. In the longer term with this type of no closing costs or low closing costs solution, it is going to be more expensive. However, I think there's always times, because the market is cyclical, and that means that it goes up and down. There are going to be opportunities to potentially refinance. Maybe when you get a lot of equity in the house, you may want to refinance and take some of that money out and pay off some debt. You may want to lower the interest rates. So there's a lot of different options out there. And then, ultimately what it comes down to when you're doing a no closing cost option is, like I said, is to look around. Not everyone's going to offer you a lender credit. Some may offer you 0.5%. Some may offer you 0.25%. Sometimes strengthening your credit a little more. Let's say taking it from like a 620 to a 660 is going to affect your closing cost by roughly 2%. And, just shop around. Just make sure you know all of your options. Always go wholesale. That's the biggest advantage. Go mortgage broker. Let them do the shopping for you. You're a consumer. You focus with everything that you need to focus on with your day-to-day life, family, and work, and then let us, the professionals, kind of handle it for you and shop around and let you know all of your different options from VA, FHA, conventional, USDA. So in conclusion, a no closing cost or low closing cost mortgage is a good option to consider when purchasing a home. However, please evaluate the pros and cons, evaluate the lenders, evaluate the programs that you're getting into. And if you have any questions at all, give me a call. My name is David Xie. Can be reached at 757-478-8493. Powered by Nexa Mortgage. We're constantly leveling up our game. And at this point, we went from 185 different investors 4 months ago to over 200 investors. So we're shopping for you to make sure that you get the best when it comes to pricing, products, and speed. I look forward to talking to you. Talk to you later. Bye-bye.